Welcome to Odisal Associates, Accounting and Finance Tutor. Welcome back to common accounting mistakes that small businesses make. This mistake, if not checked, kill the businesses. We are going to look at mistakes about failure to plan for taxes. We should know that taxes are not optional in as much as we don't want to pay. It is mandatory. Whether you run a small shop, a service business, a company, or an online brand, tax obligations will always come. But many small businesses owners ignore tax planning and end up paying penalties, creating unnecessary stress, or even shutting down. There are different kinds of tax that you must pay, whether you like it or not. In as much as you don't want to pay, but we have to pay, so long as your shops or your business premises are open. If you didn't pay, they will come, they might shut down your business. So in order to avoid all this, we need to plan for tax. What is tax planning? Tax planning simply means organizing your business finance so you know what tax to pay, when to pay them, and how to reduce your tax burden legally. It's not just how to reduce your tax burden legally, but you have to organize the finances so that you know what taxes you are to pay and when these taxes are due for payment, and then how you make the payment. This is what tax planning entails. It is not avoidance, it's not evasion, and it's not manipulation. It is using the laws available to reduce tax, stress, and improve cash flow. Yes, we can still call it avoidance because we try to use the loopholes in the tax law to reduce the tax we pay. Why small businesses fail to plan for taxes? One is lack of knowledge. Some don't even know that they need to pay tax. This small thing I'm doing, why should I pay tax? Many other owners of business don't understand taxes. VAT, income tax, payee, withholding tax, company tax, and all the taxes that you have to pay. Some people charge their customers without VAT and all the rest. When they come to collect VAT, it becomes difficult for you to pay. Ordinarily, VAT is not what you should pay from your sales. It's something that the customer should pay. But if you did not charge them, they will not pay. But definitely they will come and collect a VAT from you. Another one is poor record keeping. Poor record keeping is in everything that will run down your business. That is why the accountant is very, very important in every business. If you have poor record, you will not be able to plan for your payment of your tax. Either you overpay or you underpay. And in each of those ways, it is not beneficial to the business, whether you underpaid or you overpaid. If you overpaid, to get refund from revenue is difficult. If you underpay, you will pay penalty and interest. Mixing personal and business finances. When you mix your personal and business finances, it is difficult for you to plan for tax. The tax authority will count your personal money or finance as the business finance, and it will be a difficult thing to convince them otherwise. Another one is fear of tax authorities. We are afraid when we hear that tax authorities are coming, we lock up our shop, we close our business premises. We don't want to encounter them. Of course, whether you lock your business premises or except you want to be operating in the midnight, definitely you must prepare for them. Another one is no professional guidance. Many businesses do not consult accountants or tax experts, leading to guesswork and then inconsistent cash flow. Some businesses fail to save for taxes during profitable months, then struggle to pay when tax bills arrive. Imagine a small fashion boutique that makes steady sales. The owner keeps no proper records. Every December, the tax authority visits to assess the business. Because there is no books, they estimate tax arbitrarily, sometimes higher than the actual income. The owner becomes frustrated, believes taxation is unfair, and enters into debt. All this could have been avoided with simple tax planning and proper record keeping. Consequences of failure to plan for taxes, penalties and fines. Now, if you did not plan for your taxes, it means that you will not be able to pay for the taxes, and then the amount that you did not pay will attract interest. And because you did not pay, you will pay penalties for defaulting to pay tax. And then the amount that you did not pay will also be calculated as a rate that you pay as fine. Cash flow crisis. If you have large unexpected tax assessment, it will disturb you. It might even cripple your business. Take, for instance, a hotel business that did not provide for consumption tax and has been operating for over 2 years and has made sales of, say, 200 million for these 2 years and did not prepare for consumption tax. And suddenly, the tax authority come and say, you pay consumption tax of 4% of your revenue. By the time he calculates how much he's going to pay, he's going to run into millions in tens. At that point, maybe this 200 million he made, he has even made loss out of it. Where will he get this money to pay? He might close down the business. Loss of business opportunities. Many contracts require tax clearance. Without proper planning and you did not pay your tax, you miss the opportunity because it's not when they want this business that you start doing tax clearance. Legal issues. Of course, this is important because revenue is as good as the law. If you did not pay, they will freeze your business, take you to court. Stress and reputational damage. If you are not paying your tax, it will bring about stress. It will reduce trust. Your bank will not want to lend you money. Investors and partners will not want to continue with you. How to plan for taxes effectively. 1. Understand your tax obligation. Know the taxes that apply to your business. Company income tax, personal income tax, value-added tax, pay for employees, withholding tax, relevant local government levies. I just talked about the consumption tax, which is in some of the states. It's not in all the states. So you must know which tax that your company or your business is liable to pay to plan for it. Maintain accurate records. Keep receipts, invoices, bank statements, sales reports, and expense documentation. Good records is equal to accurate tax estimates. Accounting record is very, very important. Use accounting or POS systems. There are some point of sale system that you can use or a proper accounting system that can compute and manage your tax. Set aside money for taxes regularly. Just like we said when we were treating the last topic about inventory management, we should try as much as we can to keep a percentage of our monthly revenue for tax. You should file and pay taxes on time. Avoid last-minute rush and penalties. Create reminders for key dates. Work with a tax professional, consultant, an accountant, or tax consultant. They help you calculate taxes correctly, benefit from legal deductions, avoid penalties, and make annual filings easier. Use legal tax reliefs and deductions. This is part of legitimate tax planning. Examples include capital allowance, business expense deductions, investment incentives, small business exemptions, depending on your jurisdiction. Separate business and personal accounts. This makes taxation clearer and reduces confusion. In conclusion, I say failure to plan for taxes can choke your businesses with penalties, sudden expenses, and legal trouble. But with proper record keeping, consistent savings, timely filing, and professional guidance, tax planning becomes straightforward. Remember, planning for taxes is planning for peace of mind. A well-prepared business is a stable, growing business. In as much as we don't want to pay tax, we cannot avoid it. We must pay it. If we avoid paying tax or we evade payment of tax, it leads to severe consequences. So stay well, plan for tax payment so that you can pay your tax as and when due. Thank you. Thanks for listening. We'll come with more episode as you follow us. Bye.